Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, March 13. To view our full range of publications and trading services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. The collapse last week of two large banks has stirred fears that other banks may soon follow. Here's a look at the past week and the week ahead. After a strong rally kicked off 2023, bearish sentiment has come back with a vengeance. Not only has the stock market slumped, but the words financial contagion are being bandied about on Wall Street. Last Friday, the Federal Deposit Insurance Corporation, the FDIC, seized the assets of Silicon Valley Bank, marking the largest bank failure since Washington Mutual during the depths of the great financial crisis in 2008. Silicon Valley Bank was the largest bank serving Silicon Valley companies. The bank's collapse occurred after Silvergate Capital, one of the biggest banks dealing in cryptocurrency, voluntarily began liquidation Wednesday. Rising interest rates and a run of deposit withdrawals pressured Silicon Valley Bank and Silvergate. The news of their implosion sent the broader stock market into a tailspin. Take a look at the following chart. The Dow Jones Industrial Average is now in negative territory year to date. International stocks have outperformed the U.S. averages as global economies start to show greater strength than America's. The benchmark 10-year U.S. Treasury yield has stayed below the important threshold of 4%. Oil prices have slipped as recession worries grow. Slowing economic activity translates into less demand for crude oil. Energy generated the biggest gains of any sector in 2022. It's unlikely to repeat that outperformance in 2023. Now let's examine market breadth via 200-day moving averages. We'll start with the New York Stock Exchange Advanced Decline Line, NYAD, depicted here. The 200-day moving average is the average closing price of a stock or an index over the previous 200 days. The 200-day moving average serves as a support level when the price is above the moving average or a resistance level when the price is below it. The NYAD last week slipped below its 200-day moving average. When the NYAD rises, it's a bullish trend as more stocks are advancing than declining. A falling NYAD line is bearish for the opposite reason. The S&P 500 index last week also slipped below its 200-day moving average, as you can see here. The S&P 500 is just under the 3930 level. And as this chart shows, the NASDAQ 100 has done the same. These are three very bearish technical omens. This bear market is now 298 days old, putting it just a few days short of the average age of a bear. And therein lies some good news. This bear market is maturing. All bear markets end, and when they do, history shows that they're followed by a bull market. What's more, the S&P 500 put in a dismal performance in 2022. History also shows that back-to-back losses for the stock market are rare. But last week's bank failures have definitely soured Wall Street's mood. Are other banks about to suffer the same fate? Silicon Valley Bank was the 18th largest bank in the U.S. The majority of its clients were technology companies. The tech sector will feel the pain for a long time, perhaps for years to come. In the wake of the second largest bank failure in American history, the FDIC has stepped in to place Silicon Valley Bank into receivership. In its place, the FDIC will open the Deposit Insurance National Bank of Santa Clara on Monday, March 13, to return funds to insured depositors. But here's the rub. SVB's customers were mostly tech companies, startups, venture capital firms, and wealthy individuals. Only a tiny percentage of the bank's account balances fall under the $250,000 limit of FDIC insurance. Immediately before the run on the bank's deposits, less than 6% of SVB's total deposits were covered by FDIC insurance. The weakening of Dodd-Frank regulations helped pave the way for SVB's demise. Notably, the Economic Growth, Regulatory Relief, and Consumer Protection Act of 2018 lifted capital requirements for regional lenders. SVB's collapse is sowing chaos in the tech sector, especially among smaller firms that were left holding the bag. An outflow of deposits compelled Silicon Valley Bank and Silvergate Capital to sell assets at a loss. Those assets were bonds. Banks heavily invest in assets such as treasury bills because they need safe havens to park their cash. As the Federal Reserve boosts interest rates at an aggressive rate, those higher rates reduce the value of their existing bonds. Fed Chair Jerome Powell last week vowed to cool the economy to fight inflation. He could be getting more of a downturn than he bargained for in the form of a liquidity crisis. It's too early to say how the SVB fiasco will pan out. Other undercapitalized regional banks could topple too. Meanwhile, I've often held up CNBC's Jim Cramer as a contrarian indicator. Back in March 2008, during the great financial crisis, Cramer told his viewers that investment bank Bear Stearns was just fine, right before Bear Stearns collapsed. Well, Jim Cramer, one of my favorite contrarian indicators, has done it again. He recently assuaged mounting concerns about SVB Financial Group, the parent of Silicon Valley Bank. He even went so far as to say the stock was a compelling buy. However, shortly after Cramer's soothing words, the FDIC seized the bank's assets and California regulators shut it down. Draw your own conclusions. Now, let's look at the week ahead. Here are the major economic reports scheduled for release in the coming days. NFIB Optimism Index and Consumer Price Index Tuesday. Retail Sales Producer Price Index and Home Builders Survey Wednesday. Initial Jobless Claims and Housing Starts Thursday. Industrial Production, U.S. Leading Economic Index, and Consumer Sentiment Friday. Financial contagion could easily spread at any time, sparked by a host of factors ranging from hotter than expected inflation to overseas war to poor economic data. That's why I urge you to consider our premium trading service, the Weekly Cash Machine, helmed by my colleague, Dr. Joe Duarte. Dr. Duarte leverages a fear-based algorithm that uncovers instant cash codes that generate extra income regardless of adverse macro trends. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching, and if you have any questions or feedback, please don't hesitate to send an email to me at mailbag@investingdaily.com.